The use of limited recourse borrowing arrangements, or LRBAs, by SMSFs has grown significantly, reaching over 63 billion according to the latest ATO data. However, it is an area that faces its fair share of criticism and scrutiny. Richard Chesworth, head of specialised distribution at Bluestone Home Loans, joins me today to take a little bit of a deeper dive into the lending space. Good morning, Richard. Thank you so much for joining me today.
Thank you, Todd. It's a pleasure to be here.
Richard, I thought I would start our conversation off by taking a little bit of a broad approach. What are some of the major issues that trustees are experiencing when they obtain a loan for their SMSF?
Look, it's really interesting because the loan's only one part of the transaction. And I think it's really important that trustees actually seek the right advice and set up the transaction appropriately. Now, the right advice when it comes to advisors isn't just limited to the accountant and financial planner. It's actually aligning with a competent mortgage broker and also the solicitor or conveyancer. So from a mortgage broker point of view, we remember when the banks were in the space, they stepped out in 2018-19. And since then, over the last few years, there's been a lot of non-bank lenders in the space. So that's delivered competition through funders, which gives you more choice as well. So it's ensuring everything that the funding's right, everything's set up at the right time. You've got to ensure everything's in place before the acquisition goes through. So is the SMSF set up? Have the rollovers come across? Are you paying the deposit from the self-managed super fund? Again, when it comes to solicitors, having the contract signed correctly, not in the SMSF trustee's name, but the BEAR trustee's name, and is it a single acquirable asset? Now, we all seem to think that solicitors should get that, but whether it's an accountant, a planner, or a mortgage broker, you want to deal with someone who's got experience in the area. Now, I'm not saying they just focus on it solely, but they've got exposure and experience so they can help work with you and your customers in getting things all through seamlessly rather than trip-ups along the way.
I know you've touched on some of the key risks that members face when servicing or refinancing a loan. Can you elaborate on some of those risks that trustees may experience?
Yeah, look, there's a number of things. I think first of all, when you're setting up, you want to limit your speculative risk. And the best way to do that is knowing the asset you're buying and actually executing a contract and settling in a timely manner. There is some still exposure in the market to off-the-plan purchases in the residential space. But what you face there again is that greater speculative risk. So interest rates, we've seen the increases over recent periods. You may have been able to afford the asset back then. Can you now? Plus, what's the impact on your overall servicing of your debt outside the fund? Employment status, health status, all those things have that longer period. And I'm talking here about applying for a loan, meeting the requirements, because once the loan's set up, it's up to you to manage it going through. Family circumstances. We do get the odd occasion where one of the members is on maternity leave. So you need to have a lender who kind of can work through that process, have an understanding when they're going back to work, when their contributions are going to start and their super guarantee contributions or their employment income is going to start again to assist with servicing the debt. Different lenders will service off current versus proposed contributions because people's investment focus changes. So you might have, a customer where it's suggested their next asset purchase or their business real properties purchased in the SMSF and they don't have a history of contributions for a certain period. It's dealing with lenders who have the flexibility to assess on proposed contributions. But also raise the question here, when is enough enough? So we start looking at some lenders will only service on historic contributions, concessional contributions. Some will lend on historic and proposed concessional contributions. Some lenders will also lend on non-concessional contributions. So I'm calling out when's enough enough. We're in a low tax environment here. So if you have to service the loan off the rental income on the property or properties, returns off other assets in the fund, contributions from member being concessional contributions, and it still doesn't service, And then when we're servicing on non-concessional contributions, you've got to ask how negatively geared this loan is. In a low tax environment, 15%, you don't want to be negatively geared long term. So yeah, we're experiencing this property cycle in Australia going up and up and up. But if there's a stage, and not every property's gone up, some people have bought properties which haven't performed as expected. And if you're servicing on non-concessional contributions as well, you've got to say in X number of years, all this money is going into my loan to service the debt. What have I actually achieved in my retirement savings? So it's getting that balance right. So there's a few things out there. Just because you can doesn't mean you should. And one of those is that gearing levels within the fund.
And I know you also spoke about this as well previously in the past, but where can trustees find, or their practitioners find savings when it comes to loans or paying off loans? Do you have any little tips or techniques that you could share there?
Yeah, Todd, this is a key point. I've been active in this industry, for many years, and there's been a big focus on setting up the loans, but we've become quite passive in the way we manage as an industry SMSF loans. Now, I think the structure in itself kind of is inherently leading to that, because you can't get any more equity out of a loan like a standard property loan. So you may review that loan to get more cash out for your next purchase and the like. Or alternatively, you might what they call cross-collateralize your loan. So I've got this property, I'm buying the next one, so I'll put that in as additional security. You can't do that. It's an investment property loan in a lot of cases, or if it's your business, yes, your business real property, but then there's the rental agreements in place. It's not like a home loan where you're refinancing, you're upgrading, you're downgrading the like. So all those things lead to be actively managed. And we're not doing that in the SMSF space, and it's important to. So there's a couple of things here which I'll probably touch on. One is, a couple of loans. We're regularly seeing loans where we're refinancing, and presently Bluestone Home Loans is just residential. So we're seeing loans in the 500,000s where we're refinancing from the high 10% down to the low 7% rates. And that's a savings of $20,000 a year to the SMSF. So if you're an accountant or a planner, what better way to drive some savings to the fund on something like that? On the flip side, I do a lot of presentations with one of the commercial lenders in the market. And what I'm seeing and hearing through them is there's situations where you've got your commercial customer, the lender's either stepped out and they're not renewing the facility, so you've got to be actively managing that to find a new lender. But the other one is there were some lenders that actually extended out to 10 years interest only, but even 5 years interest only, and then principal and interest repayments over the remaining term, whether that's 5 or 10 years. That's putting considerable pressure on the self-managed super fund with that rapid amortization basis. So I know one case where this non-bank lender had refinanced a customer's commercial loan. Now, they actually refinanced on a slightly higher interest rate. So it's not just the rate, it's the flexibility. They could shift that back to a 30-year term. And that put a savings back into the actual loan payments of $9,000 a month. So that $9,000 a month, whether that was a strain on the business, whether it was a strain on the individuals outside, so it's just put more continuity in there. So they've got the capacity in a positively geared situation. Do we ramp up paying the debt down, or do we further diversify the funds to meet the future needs there? So there's some key points. It's really, we've got to be more active here and generate those savings to the customers. But one tip here, and this isn't widely spoken about, and this is where it's really important that the accountant, financial planner also work closely with the mortgage broker, because if your limited recourse borrowing arrangement was set pre-July 2018, it's grandfathered from your total super balance calculations. If you refinance that loan post 1 July 2018, now all loans from July 2018 can fall into the calculation, but some of those old ones, if you refinance it over post July 2018, if you keep the debt at the same level or less, those grandfathering provisions remain. Now, a lot of lenders, including us, will assist in the refinance if lending values permit, where we can increase to cover any discharge or exit costs from the current lender and the onboarding costs of the new lender. So we can fund that. But if you increase that older loan pre-2018, increase the balance, it will fall under the new total super balance calculation rule. So just one tip to be mindful of there.
Okay, great. And just to finish off here, LRBAs in particular always seem to be under some kind of threat. We've often seen pushes to ban them in the past, and I know the Greens have been the latest to call for their removal as part of their support for the Division 296 tax bill. But just personally here, what are your thoughts on a world, an SMSF world, without LRBAs?
I might kind of look at, I've been in the LRBA industry since 2008, and I've seen a lot of these kind of noise in the market. One thing I'll always say is there's been a lot more talk than activity. And we look at the growth over the whole period. So what's this? We're looking at 16 years now. It's been, consistent. There's been no real spikes there. You've grown from $0 to where we are now. Now, there has been a lot of talk, in the Financial Systems Inquiry, when it was at 2014, recommendation 8 was to abolish limited recourse borrowings. The government's response was for it to be left in place. However, call for the Council of Financial Regulators to do reviews in the segment. Now, we've seen a number of reviews there, and they've been really thorough. The most recent one, I think, was 2022. And rather than having a 3-yearly review, it's actually said we're going to, they don't see a systemic risk, first of all. There may be some, direct risk for people, but no systemic risk. But they also said it'll be reviewed on a needs basis going forward. But I want to break down the numbers. And as an industry, we talk about the LRBA segment, the $63 billion. Now, the Council of Financial Regulators report really kind of brought things to light for me as well, in understanding the industry itself. Because that $63 billion is the total assets securing the loans. And the total debt, as of March 2024, and the figures is $27 billion. So we're overall looking at a gearing of less than 42% on that level. If we break it down, and I was really surprised when I saw these figures, asset types, a percentage of assets securing LRBAs was 70% residential property, only 26.5% thereabouts of non-resi, and only about 3% of other assets. But then when you break that down, so I said 70% was residential properties, that only makes up 51.8% at the time of the report of the total outstanding debt. So that's $14 billion. The Australian mortgage debt is $2.2 trillion. And the Australian housing market, if we're talking on an affordability point, is 10.4 trillion. So I'm not really sure the relevance of entering a further discussion of banning LRBAs and SMSF lending in the overall scheme of things when you actually start digging down and looking at the really comprehensive facts in the reports of the Council of Financial Regulators.
As I mentioned previously, Richard is the head of specialised distribution at Bluestone Home Loans. Richard, it's been a pleasure to speak to you, and I always enjoy catching up with you. Thank you so much for your insights today, and I hope to speak to you again soon.
Well, thank you for the opportunity.